probably the most frustrating allocation that many investors and pools have made that has not paid off is recognition that the returns of the United States stock market, let's just say the S&P 500, have just been so incredibly dominant versus the rest of the world. And that those returns are really, for the last couple of years, only in the S&P 6. The S&P 494 have no return at all over that time period. And so I've got this kind of strange advice for people. I say, if you want to own US stocks, you should own those 6, knowing that you're going to take a bloodbath if you overstay your welcome. But it is a 100% momentum-based market, the most dangerous type of market in the world. I mean, I turned negative on the NASDAQ September 30th of 1999. I was really negative. Of course, in the fourth quarter of 1999, it went up 80%. But 1 year later, it was down 50% from the September 30th level. And I feel like we're in that type of an environment. Yeah. So if you're going to own US stocks, which I don't recommend, but if you want to own them, I think the only way to go is those 6. And you just got to have your finger on the exit button pretty close by. But I think that's your only chance of making money. And yet I don't want anything to do with it. But, I just think we're in the my thinking is we're in the late stage, very late stage of this momentum market. It can always continue longer than you think possible. But I do think that within 18 months, it's going to crack pretty hard. And so I think that you want to be avoiding it for the time being. And I think when the next big meltdown happens, I think the US is going to be the worst performing market, actually. And that'll have a lot to do with the dollar weakening. And so I know a lot of people have diversified out of the US on valuation reasons and on just relative performance differentials, which are really kind of mind-blowing how well the US has done versus, Japan hasn't done anything for forever. Europe's not doing anything. But, I do think that you're going to be not well served in dollar-based investments, which would include the US. And, you don't have to do it today necessarily because it really needs a rollover to start getting going. But I do think that diversifying away makes a lot of sense. So there's something that was very popular, and it gained a lot of money, a lot of AUM. It was called the permanent portfolio. And it was a very simple concept. I think it had 4 things, equal weighted, I think. It was stocks, high quality bonds, cash, and gold. And I think they were 1/4 each. And it got very successful because there was a window there in the aftermath of the global financial crisis that did really well, that mix of assets. And then it fell on hard times when stocks really got going and the AUM in that particular permanent portfolio mutual fund collapsed. But I think that's a good investment right now. I think we have such potential tail risk of outcomes, such a disperse potential outcomes, that you really need to have this kind of barbelled asset allocation concept. So I actually think owning 25% gold isn't crazy right now, nor do I think owning 25% cash isn't crazy. They're kind of the opposites. And I also don't think 25% stocks is crazy, because one thing about a potential inflationary environment is stocks can add a 0 to their prices. You might not gain in real purchasing power, but you can keep going with a nominal value that has some sort of inflation protection. And, the high quality bonds, maybe you're supposed to just have two doses of cash instead of that, because the high quality bonds, the yield is not much different than 0. I am ultimately an inflation fearing person, but in the short term, I do not think there's any inflation. I think what's happened this year is pretty clearly deflationary. And particularly, I think white collar wage deflation is going to be pretty intense. I mean, one thing about work from home is it gives you a different prism through which to analyze your business and the way businesses operate. And I'm pretty sure just about every business owner and CEO has been made aware of ways of working more efficiently remotely, or maybe they can cost cut by moving some operations to other places. Like my IT department has said to me, there's really no reason for us ever to go back in the office. There's no reason because they just live on the 16th floor on our building, off in a corner. You never see them. They're just behind a closed door typing away. They can so easily do that at home. Why do we need that office space? That's clearly deflationary. What about the traveling salesman that can't travel right now? I mean, I think most businesses are probably thinking, do I really need this many traveling salesmen? No. So there's going to be a lot of deflation in the wages of traveling salesmen. And a lot of other middle managers, I think, are going to learn that people have figured out that all they're doing is watching people work that report to them and not really doing any work. And maybe you don't need so much middle management. I think all of this is deflationary. What if somebody moves, they're tired of all the needles on the sidewalk in San Francisco and they decide they want to go to Boise? Well, you don't have to pay them as much, right? I mean, the cost of living is lower. That's deflationary. And if somebody who felt at risk of losing their job in March and April, they're probably still fearful of an event of job insecurity. I think that they're going to take a pay cut rather than a pink slip. So I do think that there's a lot of deflationary things. Weirdly, as Lacey Hunt points out so academically correctly, one weird thing about the deficit is it really isn't inflationary. It's not inflationary until you start actually declaring the liabilities of the Federal Reserve to be legal tender and actually giving money to people, which we're starting to do. That's why I'm ultimately an inflationist. When I used to give speeches, when there used to be gatherings of people, I used to routinely say, I know how to get inflation by 5 o'clock this afternoon, literally. We have an announcement from the Treasury Department that every bank account in America is going to have a $1 billion deposit at 4:59 this afternoon. That will cause inflation. Because if we don't have inflation, the lines at the Ferrari dealers would be something to behold if you gave everybody $1 billion at 4:59 this afternoon. So you can do it. There just has to be the true desire, the true commitment to doing it. And obviously, we've been ramping up this procedure ever since the global financial crisis of giving money to people. Actually, it's kind of comical how people talk about modern monetary theory or universal basic income as some wacky idea. We've been doing it since the 60s. I mean, not to the whole population, but what do you think welfare is? It's universal basic income. But it's not universal. It's just for a certain subset of the population. And it hasn't exactly solved the problems. In fact, in my view, it's made them much worse. So you can get inflation, but you have to really, really want it. I like that permanent portfolio concept. I'm going to stay there. I want massive diversification. I'm worried about deflation. And so cash sounds good. I'm worried about inflationary response. So gold sounds good. I don't like the dollar in any case. And so at a pullback, I would substantially, with a big, big pullback, I would substantially buy stocks. But at this level, I think 25% is really basically all I can stomach in the stock market. So it's just this kind of four-pillared, highly diversified thing. And, the other thing is I feel like we said earlier, the opportunities that are really good are very rare. And I want to have liquidity when the next one comes, because I think it's coming in a couple of years, not 20 years, maybe 5 years at the very outside, but maybe very well 2 years or 18 months. And so the trade is to wait for that trade.